Hello, everybody. Welcome to Wacker Chemie. My name is Jörg Hoffmann. I'm the head of investor relations, and I'd like to walk you through Q3 results. We presented them yesterday on the 26th of October. I'll show you the company presentation and have some comments for this. So if you have questions after the presentation, you'll find my contact details at the end of the presentation. And as always, happy to talk to you all. So let's begin. What you see here on the intro page is actually a sketch of a capacity expansion program that we have for specialty silicones at our Chinese site in Zhangjiagang. Zhangjiagang is one of our largest integrated silicone facilities. Means we make siloxane there, we produce silicones there, specialty silicones there, and various intermediates, and we produce fumed silica there. So all of these streams are coordinated, just similar to the way that we do it in Europe, in Germany, where we then typically also have polysilicon assets attached to this. So let's move on. As always, message from our lawyers. Q3 highlights. We achieved sales of 1.5 billion euros in the third quarter, which is about 30% lower than last year. Now, what were the major drivers? And this is something that you'll hear over and over again and again. It was essentially lower ASPs and volumes that reduced sales. EBITDA came out at 152 million, resulting in an EBITDA margin of about 10%. We saw continued headwinds in the chemicals business, similar to what we saw in Q2. But since demand has held back sales and held back the absorption of inventory, for instance, and also led to lower utilization in our plants. We had much lower solar-grade polysilicon prices, started falling for solar-grade polysilicon in the last month of the second quarter and continued at that level. So the exit rate in Q2 determined the average price for Q3. We have to look into polysilicon into three different price categories. One is the semiconductor price, which is essentially unchanged. The other is the price for materials that are processed in China, but not staying in China, but exported from China, so-called international grades. They are sold at very firm prices in the mid-20s. And the price for domestic polysilicon in China, which due to massive capacity addition, has seen a precipitous fall to about $9 to $10. High energy costs and our trailing raw material costs continue to weigh on the P&L. As always, and because it's so important to us, we show something about sustainability on the first page. We were shortlisted actually for the German Sustainability Prize in 23, reflecting progress towards our net zero targets by 2024. Overall, a difficult quarter in the third quarter. Let's move on. Following the sustained headwinds, we've updated our group guidance this quarter. We previously had a range in EBITDA between 800 million and 1 billion euros. We're now narrowing this down to the lower half of the range. So we're between 800 and 900 million. I think looking towards the midpoint is a good way to interpret this. Sales are also coming down. Other financial KPIs, however, are unchanged, especially cash generation and so forth. So we talked about the specialty silicones and expansion where we have the picture on the front page. Let's move on to the P&L. You see the P&L here. I think what you see, what's most striking is the compression of the gross margin compared to last year. This reflects the price decreases that we've seen. And you see in the bottom right, it's essentially 400 million worth of price that reduced sales and nearly 150 million on top of that from volume decreases. So high costs of energy and raw materials combined with low demand and falling prices, well, that gets you this compressed gross margin. Interesting to note, if you dig deeper into the P&L, and we have the full data available on the website. You can download Excel files with financial tables that give you all the data back to whenever, is that our financial result was actually positive. Our interest result was positive in that we earned more interest on our liquidity than we were paying on net debt. But we'll get to that later. Here's our balance sheet, pretty healthy. It's essentially a reflection of our restraint and discipline over the last years, when we were making a lot of money with price increases in excess of raw material increases. Our net debt is relatively low comparably. Shareholder equity very, very high. Our pensions are under control. So this is a healthy balance sheet, and that gives us a lot of confidence looking forward. And please don't forget, when you look at this balance sheet, we actually paid out nearly 600 million euros in a dividend in May. So there we go. Let's look into the segments. The most defining thing about the silicones business, our largest business in this third quarter, was the absence of strong demand. And this was true across all the regions. Prices for standards remained under pressure, while we are beginning to see negative pricing effects in some of the fringes and specialties. I mean, specialties is always a range. You have hard specialties and softer specialties. In the softer specialties, prices begin to fizzle, something that we had not seen in the second quarter. EBITDA overall remains burdened by a demand-driven adverse mix effect, meaning we sell relatively more standards than specialties. Typically, specialties are the ones that carry the profitability, but because demand for them is weak and you can move standards just by changing the price, the mix has changed, not enough favor. Overall output is low, and we are suffering from trailing higher raw material price. There was a crisis in the market last year when we were concerned about the availability of raws. So we bought raws at prices that are significantly now higher than what you are currently paying as cash prices if you were to buy the material today. So the problem here is that it takes, with the low demand, it takes longer to burn that inventory off. Should be done by the end of the fourth quarter. We'll see, and that will be a step change in the function of our raw materials and silicones. You see the updated outlook here, realizing that there is so little demand going on, and I recognize that many people are still talking about destocking. But considering that the demand weakness has essentially persisted for a full year now, it's probably no longer destocking. It's just the fact that our customers are producing less and are using less. On top of that, we find that customers are using this newfound availability of material, when the material was previously always on allocation, to start producing just in time. So they order in smaller installments, smaller lot sizes, and with higher frequency. Somewhat tricky for us because that means it reduces visibility and our capability to plan forward. But it makes perfect sense for them to utilize this. So as you see in the outlook, year-end seasonality is going to kick in the fourth quarter. Not a positive thing, but that happens every other year. So let's move on to polymers. Polymers is the one place where we have not changed our guidance. Despite a decrease in sales following weaker demand, largely from the construction industry, biggest weakest actually in Europe, we've been able to hold on to our prices and hold on to prices longer than it takes from raw materials to decline. In essence, we've increased our net pricing spread, and that means that we are actually looking to earn about the same level in absolute terms in EBITDA than we were able to do in a very strong market last year. Great achievement from the segment. So volumes year over year or last year were somewhat comparable. ASPs are coming down. EBITDA is literally driven by these positive net pricing benefits. And don't forget, last year we had a planned turnaround, so that explains the comps. Unchanged guidance, so I'll just skip over that. BIOSOLUTIONS, this is a business which we want to grow to 1 billion euros in sales by 2030. Obviously, when you have such ambitions and you're starting from a very low level, there are base effects, the cost of growth, and that is holding earnings back here. The other thing that we need to recognize when we look at the results in the BIOSOLUTIONS business, which at this point in time look somewhat disappointing, is that on the face of it, you don't see that there is a massive transition going on behind those numbers. The 89 million in sales last year reflected a much higher share of legacy fine chemicals products than the 77 million euros in sales that we recorded this year, which had a much, much higher share of biopharmaceutical products. The chemicals build parts suffers from the same issues as we see in silicones and in polymers. The biopharma stuff is actually going pretty strong. Nevertheless, all in all, and also we're burdened with integration costs from our recent acquisition in Spain, and the fact that we're building up for the mRNA facility in Halle, which will be servicing the German pandemic preparedness plan beginning in the middle of the year. We are just sitting on a huge stack of costs that are not productive at this point in time. That's going to change. So this is what it looks like when you start growing a business. Updated outlook, reduced profitability, but this is what it is. Polysilicon, we've actually had lower volumes in the third quarter. The sequential EBITDA decline was mainly due to the collapse of Chinese domestic solar poly pricing, as I said in the introduction. We continue to see a very clear bifurcation in the solar market for polysilicon grades, material that is produced outside of China without Chinese inputs, gets processed in China and then sold to places like the US, sees a considerable premium versus Chinese domestic materials. There's all kinds of reasons for that. Let's not delve into those, but this price differentiation is firming up. We see that EBITDA decreased significantly in the wake of this. We also had to update our outlook. The outlook essentially says a positive result in the fourth quarter, despite ongoing massive headwinds. And please do not forget, this is the part of the business where we have the highest usage of power. It consumes nearly 3/4 of the power that we buy in Germany. And power in Germany is incredibly expensive at this point in time. There's hopes about an industrial power price that is being discussed, but let's not get overly excited about this. I'll believe it when it's there. Let's see. Let's move on. Here we look at our financial position, 164 million euros in net debt at the end of the quarter. Very strong cash generation. We have like over 80% cash conversion rate in the third quarter. That's got to be a record. But you see here, essentially held back by a massive dividend that we paid out. We stick to a dividend policy. So going forward, you should expect some volatility in the dividend because we're tying our dividend to the earnings level. I'm not really looking forward to raising debt to pay dividends. So let's move on. Here's the overall overview of all the components of our guidance. I think I should have updated the depreciation line because that's probably going to be closer to the prior year level, but that's not that much of a difference. But apart from that, the only thing that's really changed is the top line and the EBITDA. Everything else we kept at this level. CapEx is going to come in at 650 million euros, maybe a little bit higher. That clearly reflects our conviction about the business and our conviction as to how we increase capacities to better service our customers. We have this 2030 targets out there that we, I think, introduced a year ago. You'll find out that in our roadshow presentation on the website, www.wacker.com. Rather ambitious plans. We have good reasons for those ambitious plans. The biggest project in our CapEx number in here is the expansion of our semiconductor grade facilities, where we're increasing the capacity of our etching lines. We already have about 50% of the market in semiconductor grade polysilicon. So I think this is the right point in time to say thank you for using our product as you're looking at this from a silicon-driven device. We are looking to increase that further and support the growth of this industry. High quality materials that are enabling the latest design rules. So everything else pretty much unchanged. Here's our appendix, the various, we can go through all the numbers. I think what's interesting is when you look into solar, how fast the solar market is accelerating. There are some people that are saying they are looking towards 400 gigawatts already in installations this year. Mind you, that's like 4 times as much as we saw 2018. Just to keep that in perspective. Also, another thing to keep in perspective here is the raws that I talked about. You see the spike in silicon metal at the end of the year, where there was severe concerns about availability of material. We're still working that off. VAM prices coming down. This pretty much also is our pricing curve. Natural gas, we saw the spike last year. We came through this with hedging. We hedged like for about 3/4 into the next year. For electricity, we hedged into the next year for about 50%. Doesn't make much sense to raise the hedging rate there because the forwards carry very high risk premium and there's no clear benefit to hedging, so we're skipping that. That said, this was our third quarter. We've published our financial calendar for the next year. There's a capital market day scheduled in here in June. We're going to hold this at our major site in Burghausen. Yeah, just keep the date in mind. You see our publications there. When you download this from the website, you'll find that there are links attached to this. I suggest to take a look at both the updated fact book and another customer magazine. And with that, thank you very much for your time. Thank you for your interest in Wacker Chemie. And again, if you have any questions, here are our phone numbers. Looking forward to speaking to you. Thank you.